Hello everybody, Jackson here with the Wealth Squad. Today we'll be talking about the market moving forward. We are looking at a upcoming downturn, but we may see a jump around Christmas time. It was about 4 years ago we saw a 5% rise in the market after a constant, uh, minus -2% red day in the market back in December of 2018. We saw that up until the day after Christmas when the market jumped 5%. That's called the Santa rally, the Christmas rally. Um, Usually you see that with retail stocks or tech stocks because, the advertising and the sales, of course, in these months are through the roof, are crazy. So what we're seeing right now is a trend continuation. We're looking at the market. We've gone from 460 back in March in the SP 500. Right now we're at 395, and we're just going down in this downward channel. But with other stocks like Home Depot, for example, you could see that it went over this line, this supposed trend line, and it's looking to fall back down into the 260, 270 range. AMD, another one, you could see, although it didn't really hit the trend line, you can see it bounce up a very, very solid amount from 55 to 78, 41% in a month. So, and now we're falling back down. So it's just like a couple days never even happened. I doubt that we are going to see the depths of this year, aka 348 on the SP 500 this in 2022. There's no way we could fall that fast that soon. However, I don't think that it is entirely impossible for next year. I'm not too sure. No one knows exactly what the market's going to do next year. And it's scary because you could lose a lot of money if you invest in the wrong ways. But you have to ask yourself, is my money better invested to make 4% yearly, right? That's what, or 3.5%. That's what these bank accounts are paying. For example, my bank account right now is paying 3.5% on just in a savings account, 3.5% a year. Are you better off investing, or not necessarily investing, but keeping your cash in an account earning 3.5% a year, or risking your money to, maybe we could go all the way back to all-time highs within 2023, right? That's what many people are looking at for a 20% gain. And then the thing with this is this can go down. Bank account cannot. So how much more valuable is a bank account compared to the stock market when in terms of you can't lose money? In terms of total loss, right? We're just, you have to think to be reasonable here. 280 down 29%. Yeah, that's a lot. But down from the top 50. So the most, it's very, 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 very unlikely that we will ever lose 50% within the next year from the highs. And at that price, we'd be at the very depths of COVID. Okay, the very, very, very depths of COVID. So from this price right now, we'd have to see a 38 to 35% drop. And that's hard to imagine. But what's easy to imagine is this price right here, 339, right? That's pretty easy to imagine considering that's the top before all this COVID nonsense. So down 14%. So would you rather continue to make 3.5% a year? No, you're not risking anything, and your reward is 3.5%. Or you risk to make 20% and go back to all-time highs, or have a bad couple months down 14% back before COVID. So it's 20 to 14 or a 3.5 to 0. Although 20% is a lot more than 3.5 by a much larger margin. And when you invest in quality companies, for example, at the right time, like Starbucks doesn't care what the market is doing, right? Starbucks does not care. If this would just go away. Starbucks does not care. So does not Adobe, but Nike recently. Nike just does not care. It doesn't really care what the market's doing as long as the stock is doing good. We also have Visa back like nothing ever happened, up from 178. Let me tell you guys a secret. Anytime you see Visa under 180, or honestly under 190, it's a buy. Buy and sell above 200. That's pretty easy way to make some chump change. But you have to ask yourself, how much more do we reasonably have to go in terms of COVID nonsense? Tech has 16.5% left to drop in order to go back to pre-COVID highs. And if that's not enough, we have 40%. And that's very unlikely because that would mean a full-on drawdown of 57, 58% from the all-time high. I don't see that as likely. What I see happening is we bounce off of this COVID level right here. That means 230 or 338 in the S&P 500 or the SPY index fund. So do what you will with this information. I don't think the early 2023 is going to be too good. This year has not been good in general. You can see December 31st was the all-time high, and we've just been down since then. Not very much. It's just been slow, right? Most of this has been slow, only down 18% in a whole year. Besides that, keep averaging in. I think an averaging consistent basis is not a bad investment over the long term. Of course not. But if you're looking to make the penny, right, you're not looking to just wing it, but you're looking to get precise. I don't consider this price out of option 338, 339. So hopefully you do with that information what you will. Hopefully make some money from it. Hopefully you don't lose money from it. And that's the video, guys. Thank you for watching. Stay safe, and I'll see you Monday.